Mate, if you've been keeping an eye on the Aussie dollar lately, you might have noticed it's been wobbling like a kangaroo on a trampoline. It's had some rough patches before, but there are quite a few reasons why the next big drop could be around the corner. The Aussie dollar's value is highly sensitive to global economic shifts, and right now, a few key factors are aligning that could put our currency on shaky ground. Whether it's changes in international demand, internal economic challenges, or shifts in global markets, we're likely in for a bumpy ride. So, grab a coffee or a beer, depending on the time of day, and let's chat about why the Aussie dollar might be headed for a serious nosedive. China's economic slowdown. China is like our biggest customer, and when your biggest customer starts tightening their wallet, it's bad news. With China facing a property crisis, slowing growth, and all sorts of economic drama, their demand for Aussie exports, especially iron ore, could drop. Less demand equals less money coming into Australia equals weaker dollar. Simple, right? But that's just one piece of the puzzle. When China sneezes, Australia catches a cold, and right now, China's economy is looking pretty shaky. The property sector, one of the biggest drivers of their growth, is in crisis, with major developers drowning in debt and struggling to finish projects. That means less construction, which means less demand for Aussie iron ore. Given that iron ore is one of Australia's biggest exports, any dip in Chinese demand hits our economy hard. On top of that, China's overall economic slowdown means lower consumer and business spending, which further weakens trade with Australia. Throw in trade tensions, unpredictable policy shifts, and global market jitters, and the Aussie dollar starts looking even shakier. If China's troubles continue, the ripple effect could send the Australian dollar into a serious downward spiral. Buckle up, mate. It could be a bumpy ride. The RBA's interest rate dilemma. The Reserve Bank of Australia, RBA, has been hiking interest rates to fight inflation, but at some point, they have to hit the brakes. If the U.S. Federal Reserve keeps raising rates while we stop, investors will start yanking their money out of Australia for better returns elsewhere. That means less demand for the Aussie dollar, and yep, down it goes. Here's why this matters. Higher interest rates attract investors because they offer better returns on things like bonds and savings. When Australia was raising rates aggressively, it helped support the Australian dollar, keeping it relatively attractive to foreign investors. But if the RBA pauses or even cuts rates while the U.S. Federal Reserve keeps tightening, the gap between Aussie and U.S. interest rates widens. Investors, always looking for the best returns, will shift their money into U.S. assets, which boosts demand for the greenback while the Aussie dollar gets left behind. This kind of capital outflow can put serious downward pressure on the Australian dollar. We've seen this play out before. Whenever the US runs a tighter monetary policy than Australia, the Aussie dollar tends to struggle. If this trend continues, the Australian dollar could be in for a sharp decline. Global recession fears. Recession talk is everywhere, and if the world slips into a downturn, riskier currencies like the Aussie dollar tend to get dumped. Investors usually run to safe haven currencies like the US dollar or Japanese yen when things get shaky. And guess what? That means our dollar could take a serious hit. The Aussie dollar is considered a commodity currency, meaning it's heavily tied to global trade and economic growth. When times are good, investors love the Australian dollar because Australia's strong export market, especially in resources like iron ore, coal, and gas, keeps money flowing. But when recession fears rise, sentiment shifts fast. Investors start pulling out of riskier assets, including the Australian dollar, and move their money into safer options like the US dollar, which tends to hold up well during economic downturns. If a global recession hits, demand for Australian exports could plummet, weakening the economy and dragging the Australian dollar down with it. Even if Australia avoids a technical recession, the fear alone could be enough to scare investors away. Combine that with other pressures, China's slowdown, interest rate differentials, and market uncertainty, and the Aussie dollar could be in for a rough ride ahead. Commodity prices could tank. Australia is basically a giant mine that exports heaps of iron ore, coal, and other resources. When commodity prices are high, we make bank. But if prices crash, thanks to, say, weaker global demand, the Aussie dollar is in trouble. We saw this happen in 2015 when iron ore prices nosedived and the dollar plunged. The Aussie dollar is heavily tied to commodity prices because our economy relies so much on exporting raw materials. When demand is strong, like during China's boom years, prices soar, and Australia enjoys a flood of export revenue, keeping the Australian dollar strong. But when demand weakens, it's a different story. Right now, China's slowing economy, global recession fears, and shifting energy policies could put downward pressure on commodity prices, spelling trouble for Australia's export earnings. Iron ore, our biggest export, is especially vulnerable. If China cuts back on steel production or turns to alternative suppliers, prices could tumble, taking the Australian dollar down with it. We've seen this cycle before. When commodity markets tank, so does our dollar. If history repeats itself, the Aussie dollar could be in for another painful drop. Australia's soaring debt. We've been spending like a uni student with a credit card, and now our national debt is looking pretty hefty. If investors start worrying about Australia's ability to manage its debt, they might lose confidence in the economy and sell off Aussie dollars. And when that happens, yep, you guessed it, our currency takes a hit. Government debt has surged in recent years thanks to pandemic spending, infrastructure projects, and welfare programs. While some debt can be good for growth, too much can scare off investors, especially if they think a country might struggle to pay it back. If Australia's debt levels keep rising while economic growth slows, credit agencies could downgrade our rating, making borrowing more expensive and further denting confidence in the Aussie economy. Foreign investors play a big role in the strength of the Australian dollar, and if they start pulling their money out due to debt concerns, the dollar could slide fast. A weaker currency also makes imports more expensive, which could add to inflation pressures, forcing the Reserve Bank of Australia into a tough spot. Long story short, if debt worries escalate, the Aussie dollar might be in for another rough patch. Housing market wobbles. The Aussie housing market has been on a roller coaster. Prices went through the roof, then interest rate hikes made mortgages painful, and now we're in a weird limbo. If the property market crashes, consumer spending could tank, the economy could slow down, and international investors might bail. That's not great for the dollar. Housing is a massive part of Australia's economy, and when prices are booming, people feel wealthier and spend more. But with rising interest rates, mortgage repayments have become a nightmare for many homeowners. If the pressure keeps building and housing prices take a serious dive, it could trigger a domino effect. Lower household wealth, less spending, and weaker economic growth. That's a bad mix for the Aussie dollar. International investors also pay close attention to property markets. If they see the Aussie housing sector crumbling, confidence in the broader economy could take a hit, leading to capital outflows. Fewer foreign investors mean less demand for the Australian dollar, which could send it spiraling downward. If the housing market doesn't find solid footing soon, it could become yet another factor dragging our currency lower. Political uncertainty and bad policy decisions. Markets hate uncertainty, and if the government starts making wonky decisions or just can't agree on anything, it can shake investor confidence. Whether it's tax policies, energy policies, or random trade spats, instability makes the Aussie dollar look risky. And when something looks risky, investors ditch it. Political and policy uncertainty can have a big impact on currency markets. If investors aren't sure what direction the government is heading, whether it's over taxes, spending, regulations, or trade, they tend to pull their money out and look for safer bets. For example, unpredictable energy policies could hurt major industries, while trade tensions with key partners like China could disrupt exports. Both scenarios would make Australia look less stable to global investors, putting downward pressure on the Australian dollar. History has shown that whenever there's political turmoil, whether from leadership changes, budget standoffs, or surprise policy shifts, the Aussie dollar tends to wobble. Investors like stability, and if they don't see it in Australia, they'll move their money elsewhere. In short, if the government can't keep things steady, the Australian dollar could take another hit. Geopolitical tensions, aka global drama. War, trade disputes, and general global drama can send shockwaves through financial markets. Australia is deeply connected to global trade, so if tensions rise, especially in the Asia-Pacific region, it could hurt our exports and weaken the dollar. Plus, if global investors are scared, they're not likely to keep their money in a currency like ours. Geopolitical risks have a way of shaking up markets, and Australia is not immune. Trade disputes, especially with China, our biggest trading partner, could disrupt key exports like iron ore, coal, and agriculture. If tariffs, sanctions, or supply chain issues start popping up, it could slow down trade and reduce demand for the Aussie dollar. A weaker export market means less foreign income flowing into the country, which can drag the Australian dollar down. Beyond trade, rising tensions in the Asia-Pacific region could also create uncertainty. If conflicts escalate, investors might see Australia as being too close to the action and move their money into safer currencies like the US dollar or Swiss franc. The more instability there is in global markets, the more pressure there is on riskier currencies like the Australian dollar. If things heat up, the Aussie dollar could be in for a rough ride. The strength of the US dollar. Like it or not, the US dollar is still the king of currencies. It's the world's primary reserve currency and the most widely traded, making it the benchmark for global exchange rates. When the US dollar strengthens, it often leads to the depreciation of other currencies, including the Aussie dollar. This happens because investors flock to the US dollar for its stability and liquidity, especially in uncertain times. If the US economy continues to grow while Australia's economy slows down, the gap between the two economies could widen, further weakening the Aussie dollar. A stronger US economy typically means the Federal Reserve may raise interest rates to curb inflation, making US assets more attractive to investors, thus increasing demand for the US dollar. In contrast, if Australia faces economic challenges like high inflation, weak consumer spending, or a slowdown in key industries, the Australian dollar could continue to slide against the US dollar. Consumer and business confidence is shaky. If Aussie businesses and consumers lose confidence in the economy, spending slows, businesses invest less, and overall economic activity drops. When that happens, international investors start to take notice, and not in a good way. A sluggish economy means a weaker currency, and before you know it, the Aussie dollar is struggling to stay afloat. When the economy is growing and businesses are confident, they tend to invest more, leading to higher demand for goods, services, and jobs. However, if confidence wanes, businesses hold off on expanding or hiring, while consumers cut back on spending. This creates a ripple effect. Less demand leads to slower growth, lower exports, and fewer job opportunities. For investors, this signals that Australia might not be the best place to park their money. They may move their capital to countries with stronger, more stable economies, causing the demand for the Aussie dollar to drop and weakening its value. The Aussie dollar then suffers as economic concerns take center stage. What does this mean for you? If the Aussie dollar tanks, everything from overseas travel to online shopping could get more expensive. Imported goods? Pricey. Holidays in Bali? Not as cheap as they used to be. Even petrol could shoot up because we import most of our fuel. On the flip side, if you're earning in a stronger currency like USD, you could get more bang for your buck. And for businesses exporting overseas, a lower dollar can actually be a win. Look, no one has a crystal ball, but there are definitely some red flags waving in the wind. Whether the Aussie dollar collapses or just takes a few hard knocks, it's worth keeping an eye on. If you're planning big financial moves, maybe consider how a weaker dollar could impact you. And if you're heading overseas soon, you might want to lock in that exchange rate before things go south. What do you reckon? Are we in for a currency crash? Or is this just another wobble on the Aussie dollar roller coaster? Let us know on the comment section below. While at it, don't forget to subscribe and like this, or even share with your fellow investors. The more knowledge we share, the better we can all navigate these tricky financial waters. See you in the next one.